a concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
Let's get the spoken word on the stock market once again with our chief equity strategist, John Blank, joining me from the West Coast via Skype. John, this market's still in correction territory?
Not really, Terry. We're well beyond it. We're 10% off the lows at 1812 at 2050. We've done a very nice rebound, and off the highs of last summer, we're 2100 to 2050 now. That's only 50 points from 2100, which is less than 2 or 3%. So we're at the very top of the trading range. And the other thing to think about here is if you do a 16 or a 16.5 on the expected earnings outlook for the S&P 500 in 2016, which we're now in April almost. So this is clearly the number to use. And the right number right now is 125. Do the math, and lo and behold, you get S&P 500 at 2062 on that 16.5 look. So this is the top of the range for a properly valued market. And the main takeaway for this market is it's very rational, Terry. It's not very unrational, it's very rational.
So just to clarify, are you saying that the correction has seen its bottom?
Yeah, I think so, Terry. As long as oil prices stay up above $40 and $35, I think we're good to go on this correction being behind us. The way we go back to it is oil does a face plant here before the summer, and we head back down to those $26 lows. Now, the reason you're not going to see that anytime soon is the April meeting of OPEC and non-OPEC players. So what's happening in April is very unprecedented, which is the OPEC and non-OPEC, meaning Russia and a few other players, are meeting to contain the supply of oil. That's a new idea that's going to keep this market certainly above 35 until then. And unless that meeting breaks up poorly, we're gonna hold on to this highs here for a while.
All right, so just quickly run down some of the fundamental and technical drivers for this market.
Well, Terry, the main thing you got to think about here is the relative strength indexes versus now versus back in October. In October, we did the same thing and rallied off the highs up to these levels of the relative strength indexes. Now, what happened in October through November into December was we staggered around off the highs. So that's one model of what's happening here. The difference between then and now is, of course, we have the oil bottom in, and that puts a bottom in for materials, industrials, and energy sectors in the S&P 500. So the reason we're not back at the November stagger around thing all depends on the oil price, because that is clearly just tracking right into the earnings of those three sectors, and they are causing all this motion to go on. So the reason we're not back in November is all about the oil price.
All right, so John, you wrote recently that jobs data is somewhat static as far as the data summary is concerned. What does that mean?
Well, Terry, to get a recession and a real face plant in the U.S. economy, you have to have rising unemployment, which has to come from negative job counts every month. In March, and we're going to get the next one in April shortly, we had plus 242,000 jobs added in February. And all the weekly data for March is showing us that the March data is going to be also strong, above 200,000. So as long as you have falling unemployment, there is no chance to have a recession. It's never been recorded. The CEO of Ford Motor Company was on CNBC this morning saying there is no recession recorded without rising unemployment, and we have falling unemployment. So that is put to bed for now. We have to see negative job counts in the United States, and we're not even close to that, Terry.
All right, and this morning that you referred to is March the 23rd, so our viewers know if they're following along on the calendar. What about the Europe story, John? How's that factoring in?
Well, the Europe story factors in through what's going on with the negative rate situation with Draghi. What's happening there is he's setting up more negative rates, which means that you have to go find some return in the bond space outside of the European Central Bank. So that's depressing the U.S. 10-year. Now we're at 1.9 or so. What's keeping down the 10-year while the Fed raises rates on the short end is the European Central Bank. So that's limiting the amount of Fed rate hikes that they can do. We've already seen that. They're now going to do 2. And the effect on the stimulus to raise rates is not happening because this central bank in Europe is pushing people into those 10-year treasuries to find some return. So what it's doing ultimately for the United States is keeping the bid on stocks, because that's where you can find some return. Dividend income stocks are getting a bid in this market.
All right, against this entire backdrop that we've just discussed, you see continued opportunity in healthcare, infotech, and consumer discretionary, right?
That's correct, Terry. I want to throw out a few names here for people. AHS Health Services, based in San Diego, ticker AHS. This is a company that is doing a temporary staffing of doctors, nurses, radio techs, and radiology techs and other things in the health system. They're doing extremely well, Terry. There's a lot of retirements going on in nursing and a lot of people, exiting positions, and these big consolidated healthcare chains really need their services. So they're doing quite well, and the stock has come down nicely since those August highs, and you still got a chance to get in on a healthcare stock really well here at ticker AHS. The other one I like is Tessera Technologies, THRS. Tessera is only 200 employees strong. They're a very small company with 120 engineers. But what they do is they license their technology for the packaging of chips, Terry. And what that means is they package all kinds of semiconductor chips together to make the same size system for many chips to be the size of one chip. So what this means is 100% of cell phones use Tessera Technologies, meaning all the cell phone makers, regardless of whether Apple, Samsung, whoever the semiconductors, use this technology because you can package chips together. Tessera is a great play if you like mobile, and they're 100% use in the mobile space, so you've got coverage that's really dramatic. You can drive up on that mobile use. The third one I like, Terry, is an old school company, 125-year-old company in Carthage, Missouri, which is southern Missouri. And this is Leggett & Platt. Leggett & Platt makes springs, box springs. And you can think, well, this is such an old business. Why would I care? Well, it's all bedding companies use it. And it's the seats, the coiled seats in all the cars. So as long as you have a cyclical bid on housing and remodeling, and you have incomes going up, which we do, and you have cars being sold at the level they are, including China, this is a company that's a sleeper play for that cyclicality. So those are the three names I like, Terry. Leggett & Platt, Tessera Technologies, and American Healthcare Systems.
All right, John, thanks for that. There you have it, spoken word on the stock market and a few opportunities thrown in for good measure with John Blank. I'm Terry Ruffalo.